No, so the debt ceiling, we think that it's all over, right? Because we passed the new legislation, the president signed it, we're going to be fine, right? Well, the problem is that the Treasury, it actually decreased its balance. The amount of cash that the United States has went all the way down to almost zero. When we say almost zero, there's a few billion dollars, but still, that's scary, a scary low amount of money for a U.S. government to have. There was a Bloomberg article or some article that showed there were dozens, if not hundreds, of individual citizens who actually had more money in their bank than the United States had in its bank account, which is just disturbing. But now you get to a place where Janet Yellen, the Secretary of Treasury, has to sell a boatload of Treasury bills or Treasury bonds to refill the cash that's supposed to be in the United States checking account, if you will. And so as these bonds hit the market, there's literally like somewhere between 600 billion and $1 trillion. And it's hard to even wrap your head around that number. But it's just so much money that needs to come from investors into the coffers of the United States Treasury. Um, and right now, it looks like Janet Yellen is going to be selling mostly short-term bonds, and that is helping to drive interest rates for these short-term bonds higher. Because whenever you sell something, the buyers have to say, like, if I'm going to buy this, I need to get something for it. And if you're trying to cram a whole lot more down my throat, if I've got to buy half a trillion or a full $1 trillion worth of something, you better give me something good if I'm going to come up with that much money to invest. So the yields have to be higher for these treasury bills and treasury bonds that are being sold. And one of the concerns that I have is since Janet Yellen has apparently decided to sell mostly short-term bonds, that means that this problem is not going away because in 6 months or 12 months or 18 months, when these bills mature, it means the US government needs to sell more bonds or more bills. And what will interest rates be at that point in time? We're kind of taking a gamble that interest rates are going to pull back, but we don't know for sure that they will. And so it puts the US in a funding risk spot where we could be seeing rates continue to be high for longer than expected just because the Treasury continues to have to sell more and more and more product into the market. Another thing that is concerning about this, we're not seeing it show up in the markets yet, but it's concerning that the more Treasury bonds or Treasury bills you sell to the market, that money has to come from somewhere. Investors don't just have trillions of dollars sitting around waiting, to buy Treasury bonds. It has to come out of stocks. Is it going to come out of technology stocks? Is it going to come out of industrial stocks? Is it going to come out of real estate stocks? It has to come from somewhere. And so there is the risk that the more selling the U.S. Treasury does, the more could come out of other areas of the market. And then finally, it's very interesting and important to note that the Treasury is now doing the same thing that the Federal Reserve is doing. The Federal Reserve has been on an interest rate hiking campaign for over a year now, and we've seen just historic jumps in yields from 0% up to over 5% on short-term things, and longer-term yields have jumped as well. Well, now the Treasury is actually behind this tailwind for yields as well, because they're selling more bonds into the market, helping to drive yields higher. So this could cause more of a tightening effect in the overall economy. It could be another trigger that leads to recession. The question is whether that recession happens in the second half of this year, the early part of next year. But we're putting more pressure on the economy the more that we sell these treasury bonds. So the deal is not over at all. In fact, in some ways, because this debt ceiling deal was passed, it actually increases some other risks that were not on the table and now are coming in a relatively big way. This also ties into the bank crisis because if we're having short-term yields move higher, it does cause the price of short-term and medium-term bonds to go lower, which is exactly what triggered the problem at SVB and the other banks that went under. So I think that we could see some more ripple effects in these regional banks. And I've gone on record, I've talked about this quite a bit actually, that I believe the business model for regional banks is broken, and I don't think it's going to get better. I think it's a slow bleed, a slow death for these smaller bank companies, and the beneficiaries are the large banks that have backing by the Federal Reserve that are considered systemically important, they're not going to be going under, and customers are going to move their money to the Citigroups, the JP Morgans, the Morgan Stanleys, the um, there was one other, but at any rate, the large banks, Wells Fargo is the other one that typically gets deposits as people are moving away from these regional banks. So you've got kind of two sides of the banking industry. The large banks are going to do okay. The small banks are dying a slow death. But Janet Yellen may be speeding up this death for the smaller banks just by pressuring Treasury bonds and moving yields higher.